Hello and welcome to the latest investment market update. I hope that you're all keeping well and enjoying our summer. I'm Brian Morman, Director of Brunsdon Financial, and today I'm being joined by Mark Shields, Investment Director at Brooks Macdonald. Brooks Macdonald have been carefully selected to manage the Brunsdon investment funds, and using their expertise, the team analyse movements within the market and make tactical changes. Mark, the last time we talked, you have positioned portfolios to be neutral in terms of equity exposure. Do you still see potential risks or uncertainties in the months ahead?
Hi, Brian, and yes, we do, is the very short answer. As you just mentioned, some of the more recent changes that we made to our portfolios was to slightly reduce our equity exposure to bring them to more of a neutral stance, just because we felt that markets had rallied very strongly since the post-Liberation Day April lows. And we do still feel that there are some potential risks on the horizon, at least in the short and medium term. Clearly, just to name a few, we have not seen the whole tariff situation go away, as it were. As I'm speaking to you at the moment, the sort of deadlines for some of these has been pushed back to 1st of August, but what happens on the 1st of August is still very much unclear. We just don't really know. There have been some noises with regards to the US coming to agreements with some key countries, but I mean, the latest one, again, that I heard this morning as I'm speaking to you at the moment, is an agreement between the US and Japan, for example. But fundamentally, what has sort of happened really with regards to the tariff side of things is a couple of sort of vague agreements, one with the UK, one with Japan, and sort of a bit of a ceasefire with China, and kind of some loose unwritten agreements with a couple of other countries like the Philippines and Vietnam. So we still have a lot of tariff risk on the table as I'm speaking to you at the moment. That could clearly have some implications as we go into the August when that deadline expires. Also, we haven't seen much of economic data yet, which has sort of actually taken some of these impacts of the tariffs that have been introduced into account. So again, that might start to filter in to the data over the next few months, which also makes us a little bit sort of nervous, as it were. And also away from the US and tariffs, we've seen, geopolitics continue to rumble on. We've seen issues in the Middle East again. Ukraine, Russia continues as it has done for the past few years. Unfortunately, we continue to see a degree of sort of social unrest, political issues, and the general situation does seem to lend itself to be a little bit more cautious, we feel, than maybe the markets are actually sort of acting to, if that makes sense.
Okay. And of course, in the US, the US administration has passed the big, beautiful bill. How has markets received this, and what issues do you see further down the line?
Yeah, I mean, again, it's a good question that has slightly kind of confused us in some ways, because there are some positive elements to markets with regards to the big beautiful bill, predominantly some of the tax cuts that are coming through in the US. But a lot of these tax cuts are basically being funded by sort of taking money from lower income families to pay higher income families in one way or another. Also, the other sort of worrying thing with regards to the big beautiful bill, as it's become known, is the implication for the US deficit situation, or the US fiscal situation. So the likelihood is that this is going to add trillions to the US debt over the next 10 years or so, and that is potentially unsustainable if kind of markets start to price US treasuries in a sort of more rational way, and that US exceptionalism falls away, and maybe we don't see as strong US growth as we have done historically. However, once again, in a similar vein to equity markets, the US Treasury market seems to have not really priced this in. So at the moment, US Treasuries are pricing in a more benign environment than they were at the beginning of the year. So again, that sort of tells us that either maybe this just isn't something to worry about, is one sort of interpretation. The other one is actually that the US Treasury market is being a little bit complacent here, and at some point the actual implications of what this means may start to get priced in. And again, we could see a fairly significant movement off the back of that if sentiment does sour.
Mm, mm. Okay. Moving away a tiny bit from the USA, do you still see opportunities in regions or countries outside of the USA?
Yeah, we do. We do sort of continue to see. We don't want to be too negative on the US, as it were. We do feel that there continue to be some extremely strong growing companies there, especially within the area of the Magnificent Seven, technology, AI, etc. But equally, we do see some risks there, and some of these companies have got extremely large very, very quickly. And Nvidia is a really good example of this. Recently went through $4 trillion valuation, which I believe is about the same value as the entirety of the UK. So some of these companies now have really kind of pushed to extreme kind of levels, and if sentiment does turn against them, as we have seen in sort of pockets of instances over the past sort of couple of years, then we could see quite a sharp pullback in those share prices in light of that. So we are a little bit cautious with regards to the US in general, away from the economic terms as well. But elsewhere, especially places like the UK and maybe to a lesser extent Europe, we probably do see some more opportunities. UK companies are sitting on a big discount to their peers. They've seen horrendous outflows, but those outflows have largely stopped now, quite simply because the major institutions haven't got any more money to pull out of the UK, if that makes sense. And we're starting to see international allocators refocus on the UK once again. And we saw back in April that actually the UK market was particularly resilient when the US was selling off. So we do feel that there are diversification benefits from investing in the UK. We do feel that there are good opportunities within sort of company levels within the UK. And a lot of people sort of regard the UK market as full of boring old financials and banks and insurance companies and things like that, which is true, and legacy companies like miners and tobacco, as I said, which isn't necessarily unfair. But there are lots of really interesting companies in the UK as well, whether it's on the software side of things or indeed on the industrial side. Companies like Rolls-Royce, really are very interesting and at the cutting edge of what can be achieved these days. So we do continue to look at opportunities away from that well-trodden Mag 7 technology dominated names that have come to really become a main part of US and global markets. We do see opportunities elsewhere, yes, and we are exposed to those.
Oh, good. Okay, Mark. Well, thank you, Mark, and thank you, of course, for watching. As always, if you have any questions or queries, please be in touch with us. Thank you.